Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is JNJ. We'll discuss, will we pass or should we play? Hello, I'm Brian Overby, the Senior Options Analyst with Ally Invest, and I am still not back from the holidays. So while we travel, we're going to jump into the new year looking at a trade in Johnson & Johnson. And with that said, we'll start by looking at the S&P 500 index. It is true that there are still believers in Santa Claus. The Santa Claus rally, which usually gets talked about every year at the end of the year, usually starts about mid-December, and it is officially over as of today, the second day of trading in January. And if we look at the chart of the S&P 500 index, this is December 16th, December 15th, had a little bit of trials and tribulations going into the actual holiday period. But as we see here, this line that I have drawn, the support level, which was actually the breakout back here in October, when we saw and going into November, this is where we had the very solid, I don't know, 1, 2, 3, 4, 5, 6, 7 green candles overall after we had that solid breakout. We got our ducks in a row again. We got the 200-day below the 50-day, below the 20-day. Right in this area, we had the market did have a green, 2 red candles and then a green candle right around that range, but it did hold once again. 50-day moving average has always been a line in the sand for the S&P 500 index all through 2021, and we did see it hold once again here. We had a solid up day after this bounce up in the S&P 500 index. Every time that we test a resistance level or a support level and we bounce off of it, it just makes that level stronger overall. And that's what we've seen here in the S&P 500 index, led into the Santa Claus rally. Time has said that, or on average, the Santa Claus rally means that the S&P 500 index or the general market is up about 1.4% in this time period from mid-December to the second day of trading in January. And guess what? We're up about 1.5% at this point in time if this strong day holds once again in the S&P 500 index. Looks like we're down a little bit now right at this period, but we did set a new all-time high once again in the S&P 500 index, which is a good sign. So I'm going to focus on this candle right here just to kind of highlight something that would have turned me a little bit more bullish on the marketplace overall if we were focusing on it at that point in time on that day and had a stock play of the day, is that we had the strong up move, but it's interesting to compare that with the VIX chart. So here's my VIX watch list. We see the VIX right now trading at 1729. It's up 4% on the day. But more importantly, this strong down move that we had in the VIX index was on that 22nd, 2 days before Christmas, or 2 days before we got, right as we were getting into the Christmas holiday, I should say. And we had a strong move down through that 20 level, which is kind of the magic level, the line in the sand between high volatility and low volatility that really got established after the downturn in the pandemic. It took forever to break below that 20% level in the VIX index, the volatility index. And then we've had the strong move. And you see that the VIX has also settled down, trading right around the 17% level on the lower end of the range over the 2021 time period. And that was a solid move in the marketplace. So it seems like there are still believers in Santa Claus, which is a wonderful thing overall. So the markets are strong. Financials were kind of leading the way. Also, we had retail stocks leading the way. A laggard in the marketplace has actually been the pharmaceuticals. And let me run over and just kind of show you a couple of charts here. So right here we have the iShares Pharmaceutical ETF. And we do see that we've had a little bit of weakness in the marketplace as far as pharmaceuticals are concerned. One of the strong places in the marketplace it has a little bit to do with interest rates. See the little bit of a pop in the 10-year, but are the financials. So the XLF is the ETF that tracks the financials. And we see here a very strong candle in the ETFs. Actually, it looks like it's set very close to a new high, but not quite there, but on the precipice of breaking out to a new high as we start 2022 overall. So I guess we'll be doing a little bit of bottom fishing today. If we look at Johnson and Johnson, the numbers behind the company overall are solid. It still trades at about a 16 and a half PE overall. So the value is there in Johnson and Johnson. We've had a little bit of volatility going into year end, but we see a big upturn in the 20-day moving average, which actually broke through the 200-day moving average. We're seeing the 50-day come back in line. Ideally, we would like our ducks in a row, right? We'd like to have the 200-day below the 50 and below the 20-day moving average. But this would be called a golden cross when you get, and I think it carries a little bit more weight when you're looking at a 200-day moving average, when you have the faster moving averages moving through some of the slower moving averages overall. And the 200-day is always one of reference that a lot of people are looking at. And when we did have this little movement up, we've had a lot of green candles overall. Now, we're still quite a ways away from its all-time high. So we're going to use options today to try to address a fear of missing out trade, if you will. We've done this before in Johnson and Johnson on the stock play of the day. So we're going to take a little bit of the weakness in the marketplace in a sector that is still strong. It's usually strong, even if inflationary factors happen overall. A lot of time, the pharmaceutical space still stays in favor during those time periods. So let's start out the new year by looking at Johnson and Johnson. So with that said, I see a lot of you out there already jumping into the chat box. Please have your questions ready. Be prepared to throw them in the chat box. It's me all by myself today, so I'm going to be doing a lot. I'm doing the options analysis, and also I'm going to be trying to address your questions in the chat box. So please do put them in there. All right, so here's what we're going to look at. We've highlighted it more than once, and I'm going to talk about two strategies today. Normally, I only look at one, but they're kind of a combination. So we're going to talk about buying leaps calls as a stock substitute. So here I have the optionsplaybook.com website up. The book I authored, the Options Playbook overall. This is the companion website, has all the text in it, just like you had the book in front of you. And we have a Rookies Corner. And one of the things that we talk about in the Rookies Corner is buying a longer term call option that's deep in the money and use it as a surrogate, or as we highlight here, a substitute for owning the stock. So we want to buy an option contract that has some oomph in it, right? It's going to have a higher delta overall, meaning that it will act a lot more like the stock, but it's still going to limit our risk. Now, obviously, we're going deeper in the money, so it's going to cost us a little bit more, but it's going to allow us to participate in this marketplace that's a little bit sketchy right now, right? We said it's that the ETF in that sector is obviously doesn't look too good. Johnson and Johnson, the chart is looking a little bit better recently. So we want to be able to participate and hope that our forecast could be correct. And how can we do that and limit our risk? We're going to buy a leap or a longer term option contract as a stock substitute. We're going to go at about 164 days. We're not going to do an actual leaps option. I think by definition, the Chicago Board Option Exchange would call a longer term, and that all that is an acronym. It means long-term equity anticipation securities. just a fancy name for an option contract that goes out longer than 9 months in time. All right. And then we're going to follow up and we're going to look at a leverage covered call. And this is a strategy that I really highlight. Leverage covered call overall is kind of the general term for the marketplace. We thought it deserved a name, so we call it the fig leaf in the options playbook. And it's mainly because you're kind of covered. You don't own the stock, but you own something that looks a lot like the stock. And that's where the name came from overall. So I always like to highlight that every once in a while. Got a new year. This talks a little bit about the name and how we came up with it, if you would be interested. It seems to have taken off a little bit in the industry, but this strategy is a very, 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 very popular strategy, almost equivalent to the covered call strategy, where you own the underlying stock and sell a call against it. So we decided that it needed a name. So I'm going to look at a fig leaf, and I think I'm going to lay down till the urge goes away. We'll talk about selling a call option, but we always want to avoid earnings when we're doing fig leaves. And Johnson & Johnson is supposed to be announcing earnings at the end of the month. And because of that, I don't know if I want to sell any premium against it. I don't want to get pegged on our shorter term option. So I'm going to talk about that. I'm going to discuss it. And I'm going to talk about maybe waiting until earnings and then looking at selling a call against the position. So let's get started. Let's run over to the Ally Invest option chains. That was the XLF. Okay, so here's the chains. Johnson & Johnson, we see it's up 56 cents on the day, about 1/3% overall. Here's the earnings date on the 25th. This is the anticipated earnings date overall. So these, if I was going to sell options, I would avoid that. I'm going to look at the 21st expiration. We're going to talk about that expiration. But here's the official paper trade for this week as I scroll down. So we're going to go out to the June 17th expiration, 164 days away. We're targeting an 80 delta. So delta, by definition, tells you, well, there's many ways that you can define delta. But when I'm looking at it in this strategy, I like to say that it tells you how many shares of stock this option contract acts like. If I owned 80 shares of stock and the stock went up 1, I would make $80. If I look at this option contract and I buy this option contract, it's bidding 1935, asking 1970. If I buy that option contract and the stock goes up 1 from 172.15 to 173.15, we would expect our option contract to go up, in theory, by the approximate delta, which is $82. So it kind of shows you the approximate number of shares that the underlying stock represents, or you could say that it is an anticipation of how much your option will move for a 1-point movement of the stock. There's many different ways that you can explain it. When I'm talking about delta, I wanted to explain it. I don't know which one will actually click overall, but it gives you a realistic expectation as what the option should do relative to the stock price. Now, there's a section in the options playbook. Feel free to check it out. Calling Meet the Greeks overall. There's a tab, and you can learn a little bit more about all the option pricing Greeks. But we obviously highlight delta inside the Ally Invest option chains. So let's run down to the strategy workbench. And I'll talk a little bit about the bid and the ask. Now, as far as option trading is concerned, this is why wouldn't you want to rent the stock, give yourself a lot of the upside potential, but have limited and known risk to the downside? I don't understand why we would ever want to buy the stock except for this reason right now, that if we're buying stocks, we have 1 cent wide markets in general. We don't have an expiration date, so that's a good thing overall, right? We don't have an expiration date, and stocks do pay dividends. And Johnson & Johnson actually has a decent dividend yield, we'll call it 2.5% overall. But in the option trading world, that always gets priced in. It's part of the reason why this option contract is at a reasonable price overall, is because the dividend actually gets priced in and lowers the price of the call options. Because when a dividend gets paid, the stock price goes down. It's a known event in the marketplace overall. So those are a couple of things that you want to think about when buying longer term options in general. But the bid ask spread is an issue. We're paying 1985 if we buy it on the ask. We're receiving 1950 if we're selling it on the bid. So we have a 35-cent bid ask spread width as opposed to a 1 cent width if we were just buying the stock outright. Now, a lot of reason why that happens is just that you have a plethora of option choices to buy, and the volume gets spread out amongst all the different expirations and all the different strike prices. We have decent open interest in Johnson and Johnson, and this is a fairly popular strategy overall, is what I would say. Well, it's a popular underlying to just trade options on. So 1,159 is the open interest. That means that many people have, or that many option contracts are out there and living. For every buyer, there's a seller. So you've got to double that contract. The more people that are interested in the option contract usually leads to a tighter marketplace overall. So having decent open interest is fairly important. Not a lot of volume in the option contract today, actually zero so far, contracts that have traded overall. So obviously higher volume, higher open interest is good for the liquidity of the actual stock. All right. So, I guess the moral to my story is if we had tighter bid ask spreads on the longer dated option contracts, this strategy would be very popular overall. It is still a very it still is a very liked strategy in the industry, but you're dealing with bid ask spreads, and some people will wane because of battling that. So if I was going to enter this trade, I don't see a lot of volume. So I'm going to probably I'm always going to work an option strategy. Very rarely will you enter a trade at market in the option space. Sometimes it could work like if you're trading something like the SPYs, the SPY, one of the most liquid option contracts, might think about placing a market order overall. But even then, I still think limit orders are your best choice. So I'm going to put this in the right rail. This is going to be the official paper trade for the day. And we got the market right now at 1950 by 1985. The midpoint is 1968. So I'm going to click on that midpoint, and that's going to put that in there. I think I'm going to have to give up a little bit more than that. I would probably, let's officially make it, and there's never a guarantee when you're trying to trade between the bid and ask that you're going to get a fill, that you will receive a fill, to use better English. 1975 would be my price that I would try to work this at. We'd be buying to open one contract. So I didn't emphasize this enough, but if I was going to buy 100 shares, I would then be looking at buying one option contract, the June 17 call option. And I apologize, we had that trade fill. This is a test account, so there are trading in this account as we speak. But with this said, we're buying to open one contract, the June 17th, 2022, 155 call option overall. 1975 would be our limit price. Good for the day. We'd click preview order, and that's how we would be looking to enter the order on Johnson & Johnson inside the Ally Invest live trading platform. So with that said, I'm seeing a few questions out there. William has a couple of questions, so please feel free to add them into the chat box and I will be addressing them. But before I go, I want to talk a little bit, before I get to your questions, I want to talk about the leverage covered call. So let's run down and let's look at the profit and loss calculator. We see here, this is one of the big upsides. So we talked about the biggest downside. The biggest downside is dealing with the bid-ask spread on deep in the money option contracts. One of the biggest upsides is that if you're correct on your forecast and the market continues on up, guess what? You gain delta. Your delta increases in value. And if you consider that on a share basis, we start with 82 delta, acts like 82 shares of stock. By the time we get deeper and deeper in the money, now it starts acting like 100 shares of stock. The highest delta can ever get is 1. You buy one contract times 100. That means that it's acting like 100 shares of stock overall. But the good news is that if it goes down and it goes down in the short term, which would be bad for us overall, we want the market to go up, but there's a time component in options. And that means that delta actually decreases as it goes against you. The more time you have, the sooner that it goes against you, the better off that you are. And you see that our green or our colored line here, we would be down on the position. But if it gets down to our 155 strike, we are not down as much as if it happens at expiration. So my line in the sand when I'm doing a leap option or a longer term option as opposed to buying the stock outright is if it does come down to my strike price, I want to get out. It's a has an expiration date, but that gives you that automatic line in the sand that you're going to choose. It's usually quite a bit below the marketplace right now. Our strike price is 155. We got the stock at 172-ish right now. So with that said, if the market does come down to that level, then we have our stop price automatically set by the strike price because we want to capture as much time premium as possible. And delta is our friend in this instance, in that it goes against us slower as it goes with us on the upside. It goes up quicker and accelerates faster than as our losses would if we are incorrect on our forecast. All right. Now, here's a leverage covered call. Here is the fig leaf. Now I'm going to tell you why I would not do it right now. If I look at our option chains, where did they go? Oh, they're right here. Silly me. And we look at the January 17th expiration, and I'm going to add one more expiration. Just want to confirm that this is the actual earnings date. So if we go out to January 28th, which is after earnings, right, we would expect implied volatility to increase. We see that the 170 vol right here is trading at about 16% implied vol, or I'm sorry, 15%. Down here, we're trading at almost 17%. So 2 percentage points usually mean that there's a known event at this point in time. And we know what that event is, right? It is the earnings date overall. So if I were to sell a call against the position, I want to, well, first of all, I'm not paying as much for the stock. So I'm going to sacrifice premium to go further out in price, right? So if I was owning the stock and I was looking at a covered call, I might consider the 175 call to sell. It's trading 93 by 98, fairly decent marketplace on it. But we're getting a little bit of a bang for our buck, saying we're willing to give up our stock at 175. But because we're doing the option and we don't necessarily own the stock, let me get rid of this, by the way. It's kind of annoying me. There we go. And we don't want to really sell the stock because we don't own it. We're just renting it, if you will. I'd probably look at the 177.50. Market is 5 cents wide in that, bringing in 36 cents as opposed to 94 cents, but giving myself another 2.5 points before it gets up to that strike. And that's what I would consider. But with that said, that's only trading at 13% implied volatility. You're just not getting a ton of juice before we go into that earnings overall. So I would probably consider, and 1 second, I have to clear my throat here, 1 second. So with that said, I'm back. I would probably wait until the earnings date and then consider doing a covered call overall. That's just the way that I would approach it. Feel free to approach it in any level that you would like. Okay. So I'm getting a little bit long-winded here. And I do see that we have a couple of questions. So let me turn over here and look at the chat box. So first of all, William says, greetings to all. Roger, howdy. William, the volume on the strike is nil. So will it be 1 when this is entered? If we did enter this trade, entered / filled, I agree, William. If it filled, yeah, you would see the volume change by 1. Open interest wouldn't change, by the way. It would only be the volume that would change overall. So volume changes today, open interest would change tomorrow. What if I get an early assignment on the Iron Condor? I don't know where the Iron Condor came from, Cybertruck. Does margin account cover price of the stock? No, it does not. If you had an Iron Condor, which means we sold a call position on it, and you got assigned on one of those call options, if you are covered, which you would be, right? You're selling a call or you're selling a put. If you're talking about the iron condor, you are covered in that. You have limited and known risk because you are buying a cheaper call or you are buying a cheaper put. Now, if the stock hasn't gone against you fully all the way to the point where you've lost the maximum, that out of the money call or that out of the money put is an issue because you don't want to exercise it. You just want to go out and buy the stock. So in that instance, you would want to trade the stock right away on the marketplace overall. So there's usually a 1 day grace period to do that. The brokerage firms will give you that, but they're going to be watching you. They're going to make sure that you cover it right away. And as a matter of fact, they may cover it for you depending on the size of the account, depending on the underlying stock. If you're doing an iron condor in Amazon, 100 shares of Amazon is obviously a lot harder to purchase than 100 shares of Johnson and Johnson, for example, uh, in general. So yes, Cybertruck, it does not account for the margin to buy the stock if you need to. All right. So you need to be awake. That is one thing that is very true. If you are selling option contracts and you don't have the cash to buy it yet, but they'll let you do the trade as long as you're approved for that type of trading. You just need they'll just watch that account closely, and if you do get assigned, they'll probably buy you back right away on the open, or and they'll expect you to do it overall. Okay, so Robert asks, "Hey Brian, rookie question. How is it a call if the stock is 172 and the strike is 155? Wouldn't that be a put? Not catching how that is a call if you're expecting it to be lower in the future." Well, this is one of this, Robert, this really comes down to the rookies course that we have inside the Ally YouTube channel, and it addresses part pricing and chains overall. So we have a free 3-part series that I did just at the beginning of December last year. There's a playlist in it. Session 2 is what you'd want to listen to, Robert. It's on demand, and we talk a lot about option pricing and just how option contracts become in the money, how they trade overall. And it's a very important session if you're a beginning option trader, but a great question overall. But I would defer to watching that video inside the Ally Invest YouTube channel. I'm very happy to be able to do that rookie course. It was very well received. And as a matter of fact, share it with your friends. It's free for everyone. All right. So is that it for the questions? I'll give you one last call. All right. And with that said, this Friday, we usually do a stock play of the day overtime. This is a very simple trade overall. We probably wouldn't make any adjustments by Friday. Obviously, if Johnson and Johnson got down to 155 by that point in time, we would consider closing it out. We're going into earnings. I wouldn't think about selling that call probably until after that earnings, going a little bit further out in time, trying to get a little bit more premium for it overall. But that would be my approach. So this Friday, we won't have a stock play of the day. I will be traveling, but I will be back the next Tuesday, or this coming up Tuesday, I guess, for the full-blown stock play of the day. I'll be back in my lovely little tiny home in my backyard, talking options once again. And please click subscribe, ring the bell, and you'll get all of the updates for all of the stock plays of the day. And we'll see you next Tuesday. Thanks for coming, everyone.